Okay, hi guys. I hope you people are doing well. So welcome to the session again. We have been discussing about the different questions on consolidations up till now. I would try to do two more questions, inshallah, and then we are going to move on to the topics other than the consolidation. Again, I'm repeating, unfortunate thing is that I don't want to waste my time on the CB practice platform right now, because at times it gets stuck and then whole year plan actually gets wrapped up. So that's why I'm using the ACCA revision kits for the sessions that I'm conducting. So bear with me for that, because I should have ideally been using the ACCA platform, but I don't want to use it now. Okay, so let's just start off. Okay, where did you share, Imran? Where did you share the question? Imran, where did you share the question? In the WhatsApp group? Okay, let me just see. Okay, just a second, please. Okay, so thank you for sharing that. I would just open up that because that's more relevant. Did you copy this whole or what? What did you do? You copied the whole of it, or it just got downloaded easily? Okay, lovely. Thank you for this. Okay, so now this is the question that Imran has also shared in the ACCA group of the SBR. And this is specific is basically a question from the mock examinations that has been published by the ACCA. So what I'll just do is that I'll just try to go through this specific mock examination. Now let's just start discussing this. The question number one is about a company called Laudium. Laudium. It says Laudium has equity interest in a number of other entities, including HINOPS. Laudium prepares consolidated financials to 31st December each year. The directors of Laudium have prepared an initial draft of the consolidated statement of financial position at 31st December 6. This initial draft is provided in Exhibit 3 as a spreadsheet. So Exhibit 3 as a spreadsheet has the initial draft of consolidated financials. The following exhibits provide information relevant to the question: acquisition of HINOPS, that's one area. So purchase of HINOPS on 1st January 2006. We are talking about 31st December 6. Loan to supplier, a business loan to a key supplier made on 1st January 6. Draft consolidated SOFP as at 31st December 6, so and so, so and so. Now let's move on to the next page and let's just see that what is happening. But before I do that, I would just like to go about with the questions requirement that are there. So the questions requirement, it says, is that explain, using exhibit number 1, explain the impact of the information provided on the measurement of the goodwill and the net assets in the consolidated statement of financial position for the year ended 31st December 2002. So what I'll do is that I've copied the requirement of the question. Okay, I've copied the requirement of the question for you people. And what I will do now is that I will actually be doing this specific scenario now. Let's just try to see. So it's about exhibit number 1. It's about exhibit number 1. Now, can you just read through this exhibit number 1 quickly? Then I'll just start discussing it. Can you read through this exhibit number 1 quickly, please? Okay, so let's just start off. What does it say? It says that on 1st January 2006, Ledium purchased 30 million of the 40 million equity shares of HENOPS and gained control of HENOPS. Now, first of all, you need to understand this thing that 30 million shares out of 40 million shares is going to be equivalent to 75% shareholding. So this is actually going to be equal to 75% shareholding. Now, next situation is, it says goodwill has been determined at $36 million, but it now appears errors were made. The following information needs to be considered. The goodwill calculated is $36 million. Now it says the purchase consideration was 1 equity share in Ledium for every 2 acquired shares in HENOPS. On 1st January 6, the fair value of an equity share in Ledium was 1.2. The issue of shares had been recorded at their nominal value. So what actually needs to be done is that the number of shares issued is going to be how much? U was 1 equity share in Laudium for every 2 shares in HINOPS. 30 divided by 2 multiplied by 1 gives you 15 million shares. Now, the fair value of the shares is 15 multiplied by 1.2, $18 million. What they should have done is that they should have recorded the investment by 18 million and correspondingly share capital and share premium. So what we need to do is that the correcting entry now is going to be investment is going to be debited, and that is going to be this 18 minus 15, and the share premium needs to be recorded by 3 million. Why? Because when you acquire the subsidiary, so you record the share capital up to the par value. So they have recorded it up to the par value, but consideration has to be recorded at fair value. So fair value was $18 million. So you should be recording it at $18 million. For those of you who have joined a bit late, we are actually doing the question number 1 from the mock examinations available on the ACCA website. Now, it says the issue of the shares has been recorded at the nominal value. Laudium incurred due diligence costs of 700,000 when acquiring HINOPS. These costs were capitalized as part of the investment in HINOPS. So the cost incurred for the acquisition are not recorded as cost of investment. The due diligence costs that have been capitalized should be expensed. Should be expensed. So you would simply say the expense is going to be debited, and correspondingly what is going to happen is that the investment is going to be credited by 700,000 and 700,000. That's what it is going to be, because you're not allowed to capitalize it as part and parcel of the cost of investment. Directors of Laudium use the book value of the net assets of HINOPS when computing the goodwill arising on the acquisition of HINOPS. So it should have been the fair value. Instead of using the book value, fair value of the assets, fair value of the net assets should have been used. Fair value of the net assets should have been used. Now, it says on 1st January 2006, the fair values of the net assets of HINOPS were the same as their book values, with the exception of following. Property, plant, equipment, which had a book value of 6 million and a fair value of 7 million. Estimated useful life was 10 years. So the fair value adjustments are what? Property, plant, and equipment. So that's actually going to be 7 million minus 6 million gives you 1 million. Then inventory with a book value of 2 million and a fair value of 2.2 million. This inventory was sold by HINOPS during the year ended so and so, so and so. Inventory 2.2 minus 2. Then you had a contingent liability with a fair value of 160,000. The contingency was resolved during the year ended 31st December 6. Okay. Contingent liability. 160,000. So 0.16 million, that's contingent liability. It was resolved. Yeah, it's okay to abbreviate in the examination. That's okay. As long as you are making sense, as long as you are not using your own abbreviation, as long as you're making sense into what abbreviation you are doing it. Directors of Laudium measure NCI at fair value at the date of acquisition of HINOPS. In the draft consolidated finances for year ended so and so, so and so, NCI at acquisition was measured correctly. Goodwill is not impaired. So NCI was measured correctly and the goodwill is not impaired. Now, what exactly is the requirement to the question using exhibit number 1? Explain the impact of information provided on the measurement of the goodwill and the net assets of INOPS in the consolidated financial statements of Laudium for the year ended so and so, so and so. Now, I'll just tell you what to do, what not to do. Explain the impact of the information provided. So now if I could just sum up all of this, the impact of the information provided is as under. The shares issued for the acquisition of the subsidiary should have been recorded at fair value instead of the nominal value. The total fair value of the shares is $18 million and an increase in the investment of $3 million being the difference between market value of the shares and the par value is to be recognized. The due diligence costs incurred are not capitalized as part of the cost of the investment and are rather okay. This adjustment will have the impact of increasing the goodwill by $3 million. Are not capitalized as part of the cost of investment and rather expense to the income statement. The adjustment would lead to a reduction in investment and hence a reduction in goodwill of $0.7 million. Right? That's what it is going to be. So there is actually going to be a reduction in the goodwill also. Now, the third adjustment was about, okay. The net assets are to be recognized at their fair values. The fair value adjustments to be incorporated in the fair value adjustments to be incorporated in the goodwill calculations for the measurement of net assets are as under. The impact of the adjustment will be a reduction of the would be an increase in net assets of $1.04 million and a reduction in the goodwill of $1.04 million. The revised goodwill should be as under. Now, first of all, cost NCI we don't know. Fair value of net assets. The cost was 15 million plus 0.7 million. The fair value of net assets, the fair value of net assets, the fair value of net assets that was given in the question. We're not being given that. Okay, we're not being given that, right? Okay, so I don't think that we could just do the calculations of this. We cannot do the revised goodwill calculation. We could just do this. The revised goodwill will be as under. Goodwill as per the question. The original goodwill established was 36 million, right? 36 million. Investment, 3 million. Due diligence cost, minus 0.7 million. Fair value of net assets adjustments is going to be minus 1.04. Hence, the revised goodwill is going to be like 37.26 million. This is going to be the revised goodwill. Do you get it now? Yeah, do you people get it now? Do you understand this, please? Okay, lovely. Now let's move on to the next requirement of the question. Zoom out. Okay, here you go. See, here I have actually started to write down the answers. This is where I actually started to write down the answer. Initially, I did the workings for myself. So you could just take a screenshot from here. Okay, let me just zoom out a bit more. This and then this area. Okay, let's move a bit forward and let's discuss further. So the next aspect of the question is, let's go on to the next requirement of the question. It says using exhibit 2, explain how loan to the supplier should be measured in the consolidated statement of financial position. How the loan should be measured in the consolidated statement of financial position. Now let's try to understand this thing. Exhibit number 2. Can you just go through it? Can you just try to do it, please? Yeah, can you just try to do it, please? Okay, let's just see. It says on 1st January 2001 or 2006, Laudium made a loan of $10 million to a key supplier. So they made a loan to a key supplier. Laudium incurred a cost of $200,000 in arranging this loan. So there was a transaction cost of $200,000. On 1st January 6th, Laudium charged $200,000 to profit or loss in respect of these loans arrangement costs. Under the terms of the loan, the supplier agreed to make interest payment of $400,000 on 31st December 6 and 7, and a final repayment of principal plus related interest of this on 31st December X8. Laudium recognized interest income of $400,000 in profit or loss for year ended 31st December 6. Towards the end of 6, the supplier began to face financial problems. Supplier made the interest payment of $400,000 that was due on 31st December 6. But then the terms of the loan were renegotiated. It was agreed that no further interest payments would be made by supplier, but that the $10 million loan amount would be repaid on 31st December exit. It is reasonable to assume that this repayment will be made by the supplier. On this basis, Laudium recognized non-current assets of $10 million in respect of the loan in draft consolidated financials in the year ended so and so, so and so. Loan documentation states that the effective annual rate of interest implicit in the loan is 5%. So that's what the loan documentation says, that the interest rate implicit in the loan is going to be 5%, right? Now just try to see this. The examiner is asking us that explain how the loan to the supplier should be measured in consolidated statement of financial position of Laudium at 31st December 2006. Now, first of all, the loan that is being made is $10 million, right? The loan issuance cost, the loan issuance cost is $0.2 million. Fair value plus transaction cost is gonna become 10.2 million. Fair value plus transaction cost is gonna become $10.2 million. I'll just explain the whole accounting. Yeah, it should be reversed. Okay. Then what actually happens is that the effective interest rate on the loan the original effective interest rate on the loan should be like this. Here, cash flows. One year down the line, year 0 is 10.2 million. 1, 2, 3. 400,000 is 0.4 million, 0.4 million. And then 10946,775. Okay, just to make things easy. 10946,775. 10946,775. Okay, I'm just gonna okay, 10.2 million is the initial outflow. 400,000, 400,000, 10946. The IRR that you're gonna calculate is gonna be IRR of these values. Let's say 0.1. So we end up getting the IRR to be 5%. So what actually happens is that the examiner had already given, but I just recalculated because he had recognized this at this 5%. I recognized the 200,000 as an expense, so I thought that maybe it's not incorporated. Now let's move a bit forward and let's discuss further. So here and then the cash flows. The IRR is this. Now what we need to do is that the measurement of the loan is like when we talk about 1st January X6. When we talk about 1st January X6, the loan should be shown as 10.2 million. The effective interest at 5% is this into 5%. The cash interest of 400,000. The cash interest of 400,000. 31st December x6. The loan carrying amount should be like this: 10310. 10310. The loan interest should be like this: 1st January 6th, this and this and this. Now, what next is there? So basically, now what is happening is that the supplier, okay, this is how the measurement of the loan should be, right? This is how measurement of the loan should be. Now, at 31st December x6, evidence for impairment as supplier is not making payment. The present value of the cash flows to be received using original effective interest rate will be this. You will now be receiving $10 million on 31st December 2008, and you will not be receiving any interest. So it's like 10 million multiplied by 1.05 power minus 2. So 907.0295 is what it is going to be. The impairment loss will be carrying amount less present value of cash flows. So the carrying amount is this. The present value of cash flows is going to be this. Hence, the impairment loss is going to be this minus this. So impairment loss is going to be 1239705. The impairment loss is going to be 1239705. Right? Okay, I'll just tell you how do we get the present value calculation. See, how much are you going to receive? You're going to receive 10 million. After how many years? After 2 years, because you're already standing at 31st December 6. So 31st December 7, 31st December 8, after 2 years, you will get this amount. So that means the total amount that would be received is 9070295. Hence, resultingly, what happens is that there is going to be an impairment loss. Right? Now, so basically, now I'm actually I've done all the calculations. I will now do the discussion that how this loan should be accounted for. The loan advance to the supplier is expected to be held till the date of maturity and meets the criteria for classification as financial asset at amortized cost. That is, the asset is held to derive contractual cash flows and the payments arising from the asset are solely principal and interest. Now, what next is there? Are solely the interest and the principal. The transaction cost of $200,000 should not be expensed, and instead they should be added to the cost of the financial asset, as the financial assets at amortized cost are initially recognized at fair value plus transaction cost. The initial carrying amount of 10.2 million at 1st January 2006 would be subject to effective interest at 5%. The effective interest amount of $510,000 shall be recognized as interest income instead of the cash received of $400,000. In order to rectify the accounting, the interest income of $100,000 additional interest income of $110,000 shall be recognized, and the carrying amount of the financial assets should be increased by $110,000. The fact that the supplier has renegotiated the loan is an indication of impairment, and an impairment loss shall be recognized. The present value of the cash to be recovered from the supplier stands at $9,070,295. Supplier stands at $9,070,295, and the present value of the cash to be recovered from the supplier stands at $9,070,295, and the difference between the carrying amount of $103,10,000,000 and the present value of the cash flows shall be recorded as impairment loss. The impairment loss of $1,239 705 is to be recognized, and the revised carrying amount of the financial asset in the SOFP at 31st December X6 shall be $9,070,295. Okay, now what have I done? I initially did the calculations. Obviously, in the examination, there would be a spreadsheet and there would be word processing, both. So you would be writing down the answer in word processing, but before that, obviously, you would be doing the calculations. So in your word processing, you would be referring to the spreadsheet calculations. Okay, the impairment and the credit loss allowance are not 100% same. There is a slight difference. The slight difference is that when we talk about the impairment loss, I repeat, there is a slight difference. What is that slight difference? The slight difference is that whenever the impairment loss is there, that means that you have to write down the asset. But whenever there is a loss allowance, the loss allowance is not writing down the asset, but it's a separate allowance that is being created. Yeah, I will just do it. Don't worry. Okay. First of all, you could take a picture of this workings that I did. Take a snapshot of this. Plus now you can take a snapshot of this. Plus this. Okay, so we are done with this specific area also. Now let's just move a bit forward and let's talk about the other aspect of the question. What is the next requirement of the question? It says, using the pre-populated spreadsheet, response option with exhibit 3 and your previous answer, adjust the spreadsheet prepared by directors of Laudium in order to prepare a corrected consolidated statement of financial position at 31st December so and so so and so. Spreadsheet should consider the following accounting for the acquisition, measurement of the loan to the supplier. Now see, what happens is that basically from the examination perspective, you would be given the spreadsheet and you would have to adjust the spreadsheet and prepare a corrected consolidated SOFP. Okay. The cash flows on impairment of financial instrument is see like this. You were expecting to recover only 10 million. So 10 million is 10 into 10 raised to power 6. But you are expected to recover this money after 2 years. So you have to calculate the present value of it. The original effective rate is 5%, so 5% power minus 2. Okay, now can you people just do this consolidated SOFP? Can you just try to do the adjustments to it? I'll just zoom out because the question we have already done. Can you just try to do some adjustments to it? Okay, now see, what's gonna happen is that I will just do some workings on this. Just a second, please. Let me just fix up my camera. Okay, see, what's gonna happen is that with respect to the consolidated statement of financial position, first of all, there's going to be a 1 million adjustment, but there's going to be excess depreciation also. We did not calculate the excess depreciation. You got to calculate the excess depreciation too. How much is the excess depreciation going to be? You were being given the life, right? The life was 10 years. So it's like minus 1000 divided by 10. The goodwill is gonna be, we already calculated the goodwill, and the goodwill has to be how much? It was to be 37.26 million. So it is actually gonna be 37260. The loan to supplier is gonna be 9070295. The inventories there's going to be no impact on inventories because the inventories would increase first, and then the inventories would decrease also because they dispose of the inventories. Plus 0.2 minus 0.2. The trade receivable, there is going to be no impact. Other current assets, apparently no impact. The share capital is going to be no impact, but other components of equity, which is basically the share premium, there's going to be an impact of 3,000 on the share premium because you issued the shares. You only accounted for the shares at the nominal value. For the non-controlling interest, we got to see that what is going to happen. Then there is this non-current liabilities and the current liabilities. I don't think that there is any impact on them, right? Now, let's just talk about the consolidated retained earnings. As per the question, the retained earnings are 34,000. Then what you need to do is that you need to see that what are the adjustments that need to be done. So first of all, there has to be this due diligence cost written off 700. Then there is this subsidiary post acquisition adjustment. The non-current liability has to increase by 160. Yes, thank you. Thank you for this. The subsidiaries post acquisition adjustment. So one of the adjustment is that there's the excess depreciation of 100. And then what happens is that the inventory had to increase because of the goodwill. Plus now you will consume it. So it will actually decrease. So that is an extra expense that needs to be charged. So 200. Multiply by how much is the ownership? 75%. So what actually happens is that this is actually going to be 300 into 75%. Gives you 225. The subsidiary post acquisition adjustment is going to be 225. Then what else is there? The loan interest income needs to increase by 110. Then there's this loan impairment, which is 1239705. I would say 1240. So apparently this is what the consolidated retained earning is going to be. Do you people understand the adjustment? 34,000 minus 700 minus 225 plus 110 minus 1240. So this is actually going to be 31,945. What is it going to be? 31,945. Next, we talk about the non-controlling interest. So at acquisition, or rather I would say as per SOFP, the non-controlling interest is 24,000 is what the non-controlling interest is. as per the statement of financial position. The next situation is we got to see the adjustments to the non-controlling interests. So the same adjustments which are pertaining to the subsidiary, which is minus 100 minus 200 into 25%. So 75 is the extra adjustment that needs to be made. Hence, it is going to be 23,925. 23,925. So the total of all of this is gonna be gives you 206,030. Gives you 206,030. 90,000 plus 1,000 minus 100. Let's hope that the balance sheet balances out. Okay, 206,230. I don't know how much is the difference. 030. So 200 is the difference. We need to figure out where this 200 is. We need to figure out where this 200 is. Yeah, what about retained earnings? Some error? The transaction costs are already there. We have already deducted 700 out of it. The transaction costs are already there. We have already deducted 700 out of it. I think it's this 200. The inventory, that's where the adjustment issue is. Anyways, as far as we are concerned, we have actually been able to complete this question now. Okay, we'll just review that. What is the 200? Maybe you could just see on your own also, and we could cover it up later on. But loan transaction cost was 200. Okay, thank you, thank you, thank you. So loan transaction cost of 200 was not added back, right? Thanks a lot for identifying. So it needs to be added up. 32,145. So we have now been able to balance out this balance sheet also. Now what I'll do is that I'll also share this this balance sheet with you people, so that select page, copy page. Let's see if I can just paste it here. Okay, so this is basically being pasted here. So does it make sense? Yeah, does it make sense? Okay, lovely. So we have been able to do this question. Thank you. Who shared it? Imran. Imran, you shared it, right? Imran, thank you for actually sharing this. Glad that you shared it. So we just did it right now, even in the class. Okay, now what I will just do is that I will just move forward. And what I would want to do is that I would want you people to try. Let's have a discussion about this. Another question. That is question number 2. Question number 2. I'll just open up the requirements of this question number 2. The name of the question was Aragon. Aragon. That's one requirement of the question. Okay, what's the second requirement of the question? What's the third requirement of the question? Here we go. So we have got these 3 different requirements of this question. Now, explain appropriate accounting treatment which Aragon should adopt for the sale of administration building. Why deferred tax can be recognized in financials, and identify and discuss the ethical issues. So let's just try to go about discussing this question number 2. The question number 2, it says Aragon has a year ended of 30th September 2000 X1. They have a year end of 30th September X1 and have been experiencing losses for several years. The first draft financials show a profit of $1 million for the current year. All directors are paid a profit-related bonus dependent on earnings. During a meeting between finance director and her deputy accountant, who has only been there in the role for a few months, finance director has commented that all accounting treatment should be followed as she has suggested. Further, deputy accountant wishes to continue within their role as they should not challenge the proposed treatment, so and so, so and so. Now, we'll just come on to that when we'll be talking about the ethical issues. Now, can you just try to do this question, please? Can you try to do this specific part? The requirement of the question is that it says, explain the appropriate accounting treatment. Explain the appropriate accounting treatment which Aragon should adopt for the sale of administration building. Can you just give it a try, please? Okay, now let's just see. It says due to a shortage of cash in the business, Aragon's director decided to sell the company's administration building for $10 million, which has its fair value on 1st October 2000 leasing it back immediately for a period of 5 years. There is no option to repurchase the building at the end of the lease term. The carrying amount of the building was $3.5 million and a transaction qualifies as sale in accordance with IFRS 15. On receipt of the cash, the whole of the asset was de-recognized and a gain on disposal of this was recorded in the statement of profit or loss. The lease rentals paid are to be written off as expenses in the statement of profit or loss. Now see what happens is that basically the sale and lease back of the administration building should be accounted for as per the IFRS 16. The sale transaction meets the criteria. The sale transaction meets the criteria as laid down in IFRS 15. Hence, the gain/loss on disposal of the asset shall be recognized to the extent of the right of use of the asset is transferred. The recognition of the entire gain shall be reversed, and instead the recognition of the entire gain should be reversed, and instead the gain should only be recorded to the extent of the right of use of the asset transferred, measured as the percentage of the present value of lease payments compared with the fair value of the asset. The lease rentals should not be expensed, but rather they should be apportioned between the repayment of the lease obligation and the finance cost. So it's a sale and lease back transaction. You cannot recognize the gain immediately in the P&L. You got to defer the gain, and you got to recognize the gain over only to the extent. You got to only recognize the gain to the extent of the right of use of the asset transferred. Okay. Is that okay to all? Is that okay to all? Okay, let's move on to the next requirement of the question, which is exhibit number 2. So the requirement of the question is that explain with calculations whether a deferred tax asset can be recognized in financials of Aragon for year ended so and so, so and so. So can you just look at it, please? Yeah, can you just look at it, please? Okay, now let's talk. It says the directors of Aragon wish to recognize a deferred tax asset in relation to $25 million of unused trading losses which have accumulated as at 30th September X1. Aragon have budgeted for profits of $25 million for the year ended 30th September X2. Directors have forecast that profits will increase by 5% for the next 5 years. Okay. Now, what actually happens is that Aragon are currently operating within tough trading environment, and sales orders for Q1 of the next financial year are at par with the trading levels of the year ended 30th September X1. Aragon operates in a jurisdiction where trading losses can only be carried forward for a maximum of 3 years. Now just try to recognize $25 million of unused tax losses are there. You have a budgeted profit of 25 million for the next year, and there's a forecast that will increase by 5% for the next 5 years. Okay, see what happens is that you got to understand this, that the deferred tax asset on unused tax losses shall be recognized to the extent that the profits will be available in the future against which such losses can be offsetted. In the current situation, the accumulated losses as at 30th September X1 just a second. Show profit of 1 million for the current year. The current year profit was 1 million. Are $25 million, and the profit as per the draft financial statement for the year ended 30th September X1 were only $1 million. Is $1 million, right? In the current accumulated losses at 30th September X1 are 25, and the profits as per the draft financials for a year ended so and so were only $1 million. Based the Q1 results of the 2000 X2 also show that the performance had been same as in 2000 X1. That is, the profits are forecast to be $1 million for the whole year, as opposed to the budgeted profit of $25 million. Since the losses can only be carried forward for 3 years, it is highly unlikely that all the losses would be offsetted against the future profits, and hence the deferred tax asset on the entire $25 million cannot be recognized. It just cannot be recognized. You just cannot recognize it. You get my point? You just cannot recognize it. Why? Because You are not expected to be able to utilize them. So if you're not expected to be able to utilize them, you should not be recognizing them. Do you get my point? Is that okay to all of you? Yeah, is that okay to all of you? Okay, lovely. Now there's this third requirement: identify and discuss the ethical issues which arise from the finance director's proposed accounting treatment and behavior. Your answer should consider the actions the deputy accountant should take. So you have to now consider the problems that are there. How would you go about it? It's like reading this specific area first, then we'll talk about it. Yeah, this is how you have to answer the questions in the examination also, Yannick. Obviously, you don't have to answer on the Excel. You have to answer these written parts on the Word document, but this is how you will do it, right? No, no, we don't need to state the standards at all, not at all. Okay, now see, have been experiencing losses for several years. The first draft financials show all directors are paid a profit-related bonus dependent on earnings. Directors bonus dependent on earnings. That's number one thing. Number 2 point is that finance director during a meeting, who has only been there in the role for a few months, has commented that all accounting treatment should be followed as she has suggested. Finance director is insisting that accounting treatments should be as per her suggestion. The Okay, see what happens is that how the marks should be allocated for these questions to the answers given we give. Now see what happens is that you see the examiner, I mean, like a lot of people, they have got this approach that 1.1 mark. See, it's not always relevant that 1.1 mark, it's not always relevant. What is more relevant is that you got to understand that if you are making sense, if you are making the points which are making sense, right? That's what you have to understand. So now let's just try to understand this thing that I mean, this is not the answer that I've written for this one. I'm just writing down the pointers over here. Uh, okay, now see what happens is that it says that all accounting treatment should be followed as she has suggested. Further, the deputy accountant wishes to continue with their role at Aragon. They should not challenge the proposed treatment. Okay. So it's like she is being intimidated. She is being intimidated to follow the instructions if she has to continue with the job, right? That's what something that she has to do. Both finance director and the deputy accountant are ACCA qualified accountants. So that's an ethical issue with them also. Ethically bound. Following exhibits available on the left-hand side of the screen. Now see what happens is that discuss the ethical issues which arise from the finance director's proposed treatment. Now see, what do you need to understand with this, that the number one point is that you need to understand is that there are issues, right? The director's bonus are dependent on earning. It's a self-interest threat. It's a objectivity threat also. It's in lack of integrity being demonstrated by the finance director. Intimidation threat is also existing, bound by the code of ethics. So what you would do is that you would actually be discussing, the answer should actually be discussing the ethical issues, plus the actions should be that discuss the issue with the higher authorities within the organization, identify the ethical obligations to the finance director too. And then what else do you need to do? You need to actually consider resigning from the role. That's what you would probably be doing. You get my point? So considering all these situations, this is something that you would have to do in the given scenario, right? Okay. So is there any other thing that you want to ask? Yeah, I'll just share, Imran, I'll just share the link to the document, because I've been saving this in a document, and the document is going to be updated as soon as we just keep on saving it. So you could just download this from there. Okay. So thank you very much, guys. Thank you for your time. Thanks for being here. See you inshallah tomorrow in the next session, and we'll take it up from there inshallah.